Hi, my name is Fiona. Tonight I'm going to be talking to you about negative interest rates. So, what are some countries that have negative interest rates? Well, there's Denmark, who implemented them in 2012. We have Switzerland in 2014, Sweden in 2015, and the Eurozone, which is the European Union, in 2014, Hungary in 2016, and then Japan also implemented it in 2016. And Japan will be the focus of my discussion. The way negative interest rates will appear in New Zealand will be by the Reserve Bank lowering the official cash rate to below zero. The Reserve Bank currently has a remit set by the Monetary Policy Committee to keep the inflation rate between 1 and 3% annually. To do this, they are given control of setting the official cash rate, which can be changed up to 7 times a year. A fun fact is the OCR has only been changed outside the 7 times twice after 9/11 and as part of COVID-19 responses. So because of the hard work of the RBNZ and retail banks over the past few years to implement the processes and systems necessary, negative interest rates in the form of a negative OCR will now be in the RBNZ's toolkit to keep inflation between 1 and 3%. The official cash rate is the interest rate that commercial banks get paid for their deposit kept with the RBNZ. It is also used for money borrowed overnight from the Reserve Bank, but at 0.25 points above the OCR. Banks often keep deposits with the RBNZ to settle end-of-day transactions with other banks, which is known as settlement cash balance. So in practice, if the RBNZ reduces the OCR to below zero, the commercial banks will have to pay the RBNZ to keep their deposits. Currently, the OCR is 0.25, which it has been since March 2020, and the government promised to keep it at 0.25 till March 2021. We have since had 2 MCR announcements where the OCR has remained at 0.25 since then. So obviously it's going to be used in New Zealand, possibly soon, but who knows. So the Reserve Bank of New Zealand has been preparing for the implementation of negative interest rates for a number of years, and there's policy documents to show this. As part of this, they required New Zealand retail banks to have systems and processes in place to implement negative interest rates by December 2020. There is a misconception that the requirements to have systems to implement negative interest rates are in response to COVID. Am I? Oh no, I'm recording. In response to COVID, but actually much of the exploration of unconventional monetary policies are a response to the global financial crisis, as obviously the actions and things are still continuing from that. It's been a really slow recovery, even though it doesn't feel like it. So in Japan, the Katsu article discusses the background reasoning for negative or neutral, for negative interest rates, being that the policy nominal interest rate should follow the natural interest rate or neutral interest rate. So where the natural interest rate becomes negative, policy interest rate should also become negative. The natural interest rate is the rate that supports the economy at full employment or maximum output, while keeping inflation constant. So in the case of Japan, Ozaki and Sudo argue that Japan's natural interest rate had declined into negatives in the years after 2008, so the policy rate change reflected that. There were a number of reasons for Japan to implement negative interest rates. Obviously, they knew that overall interest rates would decrease, which would encourage economic activity as the banks are putting more money out into the economy, leaving less in reserves. This means people are more likely to spend money and borrow money rather than saving and holding on to cash. After 2008, the Japanese yen kept depreciating, which made it harder for Japanese exporters, and they saw other countries depreciating after getting negative interest rates. In 2015, the Chinese economy experienced a slowdown, which led to stock market turbulence, which had knock-on effects to oil prices and stock prices worldwide. Japan wanted to avoid that turbulence, so in 2016, when they announced quantitative and qualitative easing with negative interest rates, they did so to surprise the market. This worked on the first day of the announcement, where Japanese stocks increased dramatically, but fell sharply the day after when people realised the banks in particular will experience lower profit due to this new policy. So how did negative interest rates look like in Japan? Well, it would look like it would in New Zealand. The negative interest rate applied to reserves held within the central bank, which is the Bank of Japan. There was a three-tier system, so a base level of money had a policy rate of positive 0.1%, whilst there was, but above that, there was reserves would receive 0%, and then any amount left over above that would be charged at the negative 0.1%. That was at 1, yeah, at the 1%. Yeah, so positive 1%, 0%, and negative 1%. So any reserve that exceeded the base and macro amount will be held at the policy rate of negative 1%, which is around 5% of the whole reserve requirement. Ultimately, there were wide-ranging effects, and the Japanese government did have to make tweaks to the policy, and they introduced the new quantitative and qualitative easing policies to reduce the negative effects they experienced. This was called quantitative and qualitative easing with yield curve control. So about as creative as the previous one. So what happened? So obviously, as they thought, negative interest rates contributed to a further decline in long-term interest rates. So it did what they expected, but it did more. This led to decreased home loan and overall lending rates, which led to lowering the bank's profits, which meant banks were less inclined to lend, and they now favoured real estate into larger companies rather than small businesses, and they had to search for new ways to build and profit, such as pivoting towards fee-based services. The long-term interest rates and overnight call rates also turned negative. Bond yields decreased, and the yield curve flattened as well. So that tells you, obviously, it's following what we expect, that the interest rates are gonna decrease. What it's saying that the market thinks that interest rates are going to decrease, and obviously the market kind of followed that. This affected the bank and insurance companies, but it also pension funds suffered because of this. The latter being even more of an issue when you consider Japan's aging population that very much needed those policies. Or those funds, I should say. There's a number of different types of banks in Japan that all had various positions within the money markets, where the money markets is trading in short-term debt instruments or investments. They used these positions once the negative interest rate came in to commit arbitrage by making loans between each other in the money market to profit off the three-tier system. Where, for example, the city banks, who had very little need for reserves, would take on loans from the other banks, such as the regional banks, that had higher reserves and needs to hold their money. And so the city banks went on to make risk-free profit. Well, the banks that took on these loans went on to make risk-free profits, while the other bank got charged less in interest. The biggest impact was the restructuring of Japanese banks. While on the surface it appeared that Japanese banks had not shrunk in terms of the brands that people were seeing, many city banks had experienced mergers and acquisitions, and a number of banks are now owned by regional financial groups. This effect on the banking industry had the greatest effect on rural areas outside of large urban areas, which is also where a lot of Japan's issues were already happening, particularly around the aging population. So it just kind of made a bad situation worse. So to be honest, we've talked a lot about how it's important to maintain 2% 2% inflation rates. But what does that even matter? Well, a lot of countries that have introduced negative interest rates have done so in the name of maintaining inflation at 2%. So while New Zealand wasn't the first to use 2% inflation, it was the first country to introduce inflation targeting formally. In 1989, the Reserve Bank of New Zealand Act came into force. According to Brown, it included the mandate to reduce inflation by 2% each year, which at that time was 5%, which today it is to maintain inflation between 1% and 3%. This was part of the finance minister at the time's impetus to make our central bank accountable in a transparent way. So by making sure the inflation is reduced and maintained at a stable level, there is now a measurable way for the people to keep the Reserve Bank accountable and show that the bank was being effective and doing things and not just mucking around. Japan's experience is often cited as a reason to not use negative interest rates. It is also touted that there is only a temporary measure as part of post-2008 recovery measures. However, interest rates continue to go down and seem to have no planned way out of the spiral. And Katsu also sees this and argues we need to find a way to pull ourselves out of the continuous downward progression of interest rates. We lowered interest rates post-2008 to stimulate the economy to speed up the recovery, which otherwise would have been prolonged and painful for people. So by lowering interest rates, we are able to avoid that. However, once the Western world recovered, they did not seem to stop lowering interest rates. And it seems as though we're in a perpetual recovery with no end in sight, especially with the introduction of negative interest rates. But it does deal with the fear that we're going to hit zero and have nowhere to go back up, which would hurt the economy, and most central banks only want to positively affect their economy. Brown also goes into issues of taxation and the cashless society, and by extension of that, to crime. By charging 1% on reserves or a portion of a reserve held with the central bank, we're in essence performing pseudo-taxation. where banks and bondholders and other groups that have dealings with the central bank get essentially taxed for holding their money with the central bank. It also leads to double taxation, where money the banks and others have earned has already been taxed and is now being taxed a second time by the central bank. It violates a commonly held principle within society that money should only be taxed once. Similar to this, many in New Zealand would argue GST is double taxation, as the money we use to buy things has already been taxed as income, so GST is argued to be taxing that money a second time. Beyond this, paper cash and negative interest rates seem to be incompatible. So it is argued by Brown that those who argue for negative interest rates are also in favour of a cashless society, particularly for the reduction or removal of large denomination paper notes. I think his argument is reaching. However, I do agree with the assessment that the removal of large denomination notes and cash in general will not reduce crime, only that it will move into more traceable and more visible places such as bank transfers. So this is a discussion. Things I want people to think about are: do the positive effects of negative interest rates used as a recovery tool outweigh its effects in the long term, such as the reshaping of banks with lower profits, if not losses? Are pseudo-taxation concerns justified? And should we continue aiming for around 2% inflation? And should we maintain 2% inflation at any cost? I hope this has given you something to think about. Have a good evening.